What is going on, guys? Welcome into Stock Talk with Nico Criticos. Today, we're going to be checking out Fubo TV because it recently had a ginormous move. As you can see here, in the last week, the stock is up 284% after it was trading at about a dollar, and now the stock is over $5 a share. So the last couple of years, I mean, ever since the IPO, there's been insane volatility with this stock. Just a couple of years ago, the stock was trading at nearly $50 a share, and then for these last couple of years, it was pretty much trading at about a dollar, and now we're back up to five. So the reason for this is because it looks like there's a deal happening between Disney where they are combining Hulu with Fubo. And so that's the big news. Now, in terms of investing in this or the valuation, I would say so when you look at the price, we can't look at price to earnings because they haven't made a profit. But price to sales, this is the most expensive it's been now for a while, right? But with that being said, it's been trading at 0.2 times sales, which is insanely cheap. And so now that it's trading at about one time sales, I mean, the company is a $1.7 billion market cap, and they're going to do about 1.6 billion in sales and then 1.8 billion next year. So from that perspective, and I know they're not profitable yet, but they're getting a lot closer to profitability, right? I would say that the valuation is really not that bad. One point, because I see a lot of companies that are in a similar position. They're growing 10 to 20% revenue and they're losing money and they've lost money for several years. And it'll be trading at a $10 billion, $15 billion valuation. In those situations, I think that's ridiculous. But in this situation, a $1.7 billion valuation is very understandable and is actually a lot cheaper than a lot of these other tech companies and stuff that I see. So I think this is I think this is great news for Fubo TV. I think the valuation is not bad. I'm not interested in investing just because I don't know. I mean, one, I like to have profitable companies. I just feel better valuing the company when it's producing a profit versus just betting that one day it'll make a profit. I mean, for a stock like this, maybe I'll throw in a couple $100 or something just for like a gamble. Just, you have to expect that you might lose half your money. And so if I throw in $500 and I lose half my money, or even if it goes down 90%, it's not the end of the world for me. So that's how I look at this one. I mean, the revenue growth the last couple of years has been pretty strong. As you can see here, I mean, they've gone from 5 years ago, 6 years ago, $4 million to then 1.3 billion, and now trailing 12 months we're at 1.6 billion. So again, the price to sales is about a one, which is pretty cheap, really. I mean, it's pretty cheap for their situation. But it's things like this where the shares outstanding is just going up like crazy. I don't like that. The cash to debt ratio is not looking very good. I mean, it's not horrible. I mean, they can still get past that, but it's just things like that. Now, this news with Disney, that could be a big deal, right? That could be a really big deal. And this could be the thing that drives them into profitability. So, if you're someone who is investing in this, I sort of understand. I mean, even if you're buying at this price, I really think that, this is a stock where you're betting for a more, on a longer term basis where you're thinking, okay, this stock could be $20 or $30 maybe 5 years from now, something like that. So if as long as they get more users and they're getting more integrated and all that stuff, then I don't see why that can't happen and why this couldn't be a $5 billion or $10 billion company in a couple years from now. But at the moment, it's still kind of a risk, and a lot of companies like this, they don't end up making it, or they just stick around these low valuations forever. One that I did invest in a couple years ago that is somewhat similar is Curiosity Stream, and they were a streaming company that were going to produce um, documentaries and stuff like that, educational shows, and look where the stock is. I think I bought the stock at probably the same price. And I mean, look, it was $1.80 3 years ago, and it's still $1.60. And I mean, they had a good management team and good backing behind them and stuff. It didn't work out though, right? And whether that means they didn't get put on enough different streaming channels or whatever it is. So these things happen and doesn't mean every company is going to make it. But you never know. It's hard to predict. And so if Fubo was trading at five times sales, I would say no, I wouldn't do that. But with it trading at only one time sales, that's not as risky as a lot of these other stocks. So, if you're someone who watches Fubo TV or you think that they have some sort of competitive advantage, then I can understand why you're investing. So I don't think it's the worst investment. I don't think it's the best investment. It's just one that I'm not interested in. But that's all I got to say about that one. Thank you very much for watching, and I will see you in the next video.